Thanks for being with us here on Business Now. Well, construction, obviously, is one of the most important industries in this country from the perspective of employment, from the tax it pays, from infrastructure and homes that it builds. A new report today says labour shortages continue to hinder the industry and more companies are going broke. But with the government pledging $10 billion to its Housing Future Fund, also increased defence spending in the future, it just might be eventually a little brighter out there. The big question is whether government can help plug gaps in labour shortages and structural barriers to building. Mackey is the Executive Director of Cost and Commercial Management at Arcadis, which did this analysis, and he joins me now. Matt, many thanks for your time. I just want to go to this whole point about the way in which the construction industry is just having to sort of price itself right now, and whether it really can commit to many of the projects that are coming simply because whether there's money there for them or not.
Well, there's a couple of different parts to that, particularly when you start looking at it from a state-by-state basis. But generally, what we've seen pretty much since the pandemic is that costs have risen pretty much exponentially, well above long-term trends. And we're beginning to see that settle a bit now. So costs are still above average, but they are rising at, let's say, a less significant pace than what they have been. What we're seeing in certain states, particularly if you look at New South Wales and Victoria, is that the pipeline of work down there is actually diminishing. It's actually reducing from what it has been over the peaks of the last 10, 15 years. But we are seeing that shift now over towards, say, Western Australia and Queensland and Brisbane and Perth in particular. Perth has been extremely busy over the last couple of years. Costs in 2024 alone in Perth went up by about 11%, which shows the buoyancy of that market and how busy that market is. Brisbane hasn't quite got to the same level yet. We're still waiting for a lot of that work to actually happen, particularly in terms of the public infrastructure and the investments that are coming from state government, and we're waiting for that pipeline to hit. But the confidence of the pipeline in Brisbane and South East Queensland in particular, what with the Brisbane 2032 Olympics, is pretty significant. So we're seeing that shift now from Victoria and New South Wales really carrying the load in terms of construction, that shift now to, say, Queensland and Perth and potentially South Australia as well.
And one of the things I often hear, Matt, is about the government and many of the big infrastructure projects that the states have embarked upon, really almost crowding out the private sector in terms of labour, in terms of materials, and this has been driving up costs in the past. Is this still happening, or are some of those bigger projects now finishing, meaning there's more opportunities in the private sector?
Well, we're certainly beginning to see more opportunities come through for private sector now. The problem the private sector has had over the last 2 or 3 years is viability and whether they can actually get projects to stack up financially in terms of business cases. So when infrastructure spend and big infrastructure, transport infrastructure projects were largely in play, we did see a lot of contractors move to that side of to that kind of sector because there was potentially more EBA-based work. So we were seeing that capacity crunch, if you like, with the private sector. We're seeing that lessen a little bit now. There is certainly less transport infrastructure in play than there were perhaps 4 or 5 years ago. There is still a lot, but we're seeing a bigger shift now to social infrastructure, health spends, education spends, and when you look at Queensland, you've obviously got the Olympic spend coming up as well. So we're seeing more shift towards more property, but there is still that viability issue going on. It's potentially just not as pronounced as it has been over the last couple of years.
So one of the reasons why many of those construction companies went broke when they did, and there were big companies that fell over, effectively it was because many of them had taken on fixed priced contracts when their costs accelerated for labour and for materials very, very quickly. Now, as that eased off and a fixed price contracts now less of a thing in the industry than they were in the past?
Well, I would like to say that fixed price contracts are not as prevalent as they were. That would be lying, though. What we're certainly seeing is, and again, it changes from state to state. Australia is a very, the construction industry across Australia is obviously very, very large and very, very segmented. We are seeing a change in attitudes in some states. So where workload has been picking up, clients have been more willing to look at collaborative-based type contracts and look at rise and fall mechanisms to cover cost increases for certain materials. Other states where there's been a bit of a contraction in terms of potential work opportunities are certainly moving more back to more risk-based and more fixed-price type contracts, which is not necessarily good for the long-term health of the sector. In terms of the issues that were coming from pandemic, in terms of those fixed prices and rising material costs, that has largely abated. There are still some peaks in certain materials, but that is not as prevalent as it was. It's now more about the types of contractors the types of contracts the clients are putting out there and that contractors are signing up to.
I'll tell you, it's going to be fascinating just to watch this space into the future. Matt Mackey from Arcadis, I appreciate your time here on the program today.
Pleasure, thank you.